stocks slumping, major indices at session lows as trade tensions continue to ratchet higher. The Dow wiping out its gains for the month of June. Mike Santoli is with us at Post 9 with that. Mike.
Yeah, John, still kind of trapped in this trading range environment. I have a column up just now on CNBC.com that looks at about the midpoint of the year and a very unusual path to what seems like a fairly routine total year return. So what's unusual about it? Well, we had the best January ever, the best start to any year in 31 years. Then you had the sharpest decline, the fastest 10% or more drop from a record high in 90 years, followed by an unusually prolonged process of repair, recovery, chopping around. And you see right there, we kind of slumping right back down toward the middle of the year-to-date range. What does it actually mean? Well, we're coming into today, we were on track for about an 8% total return for the year, including dividends. Now on track for about a, let's say, 6.5% return, which wouldn't be bad. But here's why it feels kind of nerve-wracking, because it's a little bit of a push-pull between the good corporate fundamentals and the financial tightening, an uneven market. You have many more industry groups underperforming the S&P 500 by a lot than you have outperforming, uneven geographically too. The rest of the world is still really in correction mode. The U.S. is trying to buck that trend. I think the bulls, the uptrend is intact, but by a thread. Right now, you're kind of holding on to the longer-term uptrend. Friday was the longest ever stretch with the Dow not closing below its 200-day average. There's no magic trigger if we close below that. So I do think you have to give the benefit of the doubt to the fact that it would be an extremely unusual year if we didn't end higher when earnings are up 20%. Credit markets are not blowing up, and the economy is growing pretty quickly.
Although it sounds like something we said during the first 10% down.
Yes.
Or earlier this year, right?
Exactly true.
It's episode 1, right? Don't try to string it out. But if we do go back again, then what?
I mean, go back. I would have to define go back. I mean,
10%.
if we go back to those lows, I don't think it necessarily means it's over, because you did have one of those kind of double dip corrections in 2015 into 2016. And the second time you kind of tipped toward the lows in early 2016, that was a low. But again, you're not really seeing the same dynamics here, because then you had the kind of earnings declining, the market sniffing out a recovery.
Yeah.
Right here, you have the opposite. The market is kind of turning up its nose at very good earnings growth.
One of the things that we haven't been talking about very much yet is midterm elections and the impact that could have as well. Because I know historically, in years where you've had midterms, you've actually seen a move to the upside in stocks afterwards.
Afterward, exactly. Afterwards. I mean, it usually is a little bit kind of anxious going into it. It's very hard to handicap right now. I don't know exactly what the market perceives as the outright stakes for the economy or for policy going into these midterms. But it is historically true that the summers before midterm election, they tend not to be that great. And I think you have the same kind of choppiness out there, the market getting a little bit nervous that it might be something more than just a one day here. But again, we're back down to just 4 week ago levels in the S&P 500. It's very hard to make too much of it when we've seen so many of these instances where literally it looked like this at 11:30 and at 4 o'clock you had minimized the losses.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.